Well, thank you very much, and good morning. Overall, we have a better than expected outlook, and let me start with our key messages. First, the EU economy has avoided a recession. It expanded in the first quarter and is set to continue growing moderately. Second, the key factors underpinning this forecast go in opposite directions. On the one hand, declining energy prices and a resilient labour market, and on the other hand, tightening financial conditions. Third, headline inflation is declining rapidly, but core inflation remains high. Fourth, government deficit and debt ratios continue declining. Fifth, the balance of risk has tilted back to the negative side. Finally, let me welcome the inclusion in this forecast for the first time of sections on the new candidate countries, namely Ukraine, Moldova, and Bosnia-Herzegovina. A first key positive change underpinning this forecast is the further fall in energy commodity prices. Wholesale prices of gas and electricity in the EU have come down significantly from the peaks of last year and continue declining even after the winter forecast, thanks to effective diversification of supply and sizable fall in consumption, also supported by mild temperatures. The major concern for the European economy, that is a disruptive shortage of gas supply, did not materialize. Gas prices reached 35 euros per megawatt hour at the end of last week, the lowest level since summer 21. Future prices for 23 and 24 had declined as well. As the EU approaches the gas refilling season, gas storages are at comfortable level and risks of shortages have considerably abated. Electricity prices have declined in parallel with gas, while oil prices are expected to decrease over the forecast horizon. With important energy prices rapidly falling, the trade balance for goods is set to improve. And with it, the current account surplus is set to rebound from a very low 0.5% in 22 to 2.3% in 24. In 21 and 22, the surge in imported energy prices resulted in a transfer or purchasing power from the EU to the rest of the world. The rapid fall of energy prices is driving a reversal of this effect, to the benefit of the domestic sectors of the economy, households, corporates, and governments. The EU economy continues to be underpinned by the strongest labour market in decades. Unemployment rates keep hitting record lows, and the participation and employment rates stayed at record highs. Despite the expected slowdown in economic activity, the labour market is set to remain strong. Continued labour market tightness, labour hoarding due to skill shortages, as well as the strong performance of the service sector, are expected to keep the unemployment rate broadly stable at around the current record lows in both 23 and 24. Nominal wage growth picked up in 22, and more substantial wage increases are expected this year on the back of significant increases in minimum wages in several countries and, more generally, pressure from workers to recover lost purchasing power. Still, wage growth is set to fall short of inflation again this year, while a significant recovery of real wages is expected to take place next year. Corporate profit margins have been on the rise since 21, providing a potential buffer for the absorption of wage increases. The strong growth in labour costs is set to lead to a reduction in these profit margins in 2024. Last but not least, another important tailwind for the outlook is the continued deployment of the RRF, including REPowerEU. Over the forecast horizon, absorption of RRF grants is set to increase from 0.3% of GDP in 2022 to around 0.4% of GDP in both 23 and 24. This is the average. Over the 21-24 period, expenditure financed by RRF grants is expected to be above 3.5% in Spain and Greece, more than 3% in Croatia and Portugal, around 2.5% in Slovakia and Italy, around 2% in Latvia, Bulgaria and Romania, close or above 1.5% in Lithuania, Poland, Hungary, Cyprus and Czechia, and more than 1% in Slovenia, Malta, Estonia and France. To be clear, of course, these projections are based on the planned timeline for milestones and targets set out in the plans. Now, to turn to a less positive factor, the tightening of financial conditions is set to weigh on economic activity over the forecast horizon. The progressive firming of core inflation has set EU monetary authorities on a path of forceful tightening. Compared with our previous forecast, market expectations point to higher rates, though markets still expect the ECB to be nearing the end of its tightening cycle. At the cut-off date of the forecast, the euro area short-term rate was expected to peak at 3.8% during the third quarter of this year, before abating in the course of 2024. The tighter monetary conditions are feeding through the credit channel with rising borrowing costs and decelerating credit flows to both firms and households. Banks' heightened risks perception, in particular also in the aftermath of the crisis that we experienced in the US and Switzerland, is likely also contributing to tightening lending standard. What this means is that credit is not only more expensive, but also more difficult to access. At the same time, higher interest rates are leading to a decline in loan demand. It is important to note that the cooling of the EU credit market is a sign of effective transmission of monetary policy normalization, rather than a sign of weakness of the EU banking sector. Thanks to reforms implemented since the global financial crisis, indeed EU banks have solid capital position, robust asset quality, and sufficient liquidity buffers. So in the first quarter of this year, GDP grew by 0.3% in the EU, which is slightly above the projection of our previous forecast. Information available at this stage for only a few countries points to subdued consumption growth and robust investment growth, despite the tightening of financing conditions that I just mentioned. Net exports contributed to growth thanks to the improvement in terms of trade and a strong tourism performance. For the second quarter, survey indicators suggest continued expansions, with services clearly outperforming the manufacturing sector. In particular, the energy-intensive manufacturing sectors are still reeling from the energy shock of last year. Consumer confidence has continued also its recovery from last autumn's historic low. Overall, growth this year in our forecast is set to reach 1% in the EU and 1.1% in the euro area. So no recession, but subdued growth. Following the weakness in the past 2 quarters, private consumption is set to increase moderately this year, as inflation keeps eroding households' purchasing power. Housing investment, which is, of course, particularly sensitive to interest rates, is expected to contract. By contrast, business investment is projected to still increase, though at a slower pace than last year, helped by corporates' overall healthy balance sheet position and the rollout of the RRF. Net exports are expected to contribute positively to GDP, but only moderately. Weaker demand from key trading partners and a stronger euro weigh on exports. Furthermore, the rebound in economic activity expected in China is set to benefit primarily the domestic sectors, services in particular, with limited positive spillover to the EU. In 2024, growth is expected to gain strength. Moderating inflation, continued employment expansion, and strong wage growth are projected to boost households' real disposable incomes, leading to a rebound on private consumption. Investment is expected to be supported by the RRF, despite the delayed impact of monetary policies tightening. Stronger import growth, in line with strengthening domestic demands, lowers the contribution of external demand to growth. Overall, annual GDP growth is projected for 2024 at 1.7 in the EU and 1.6 in the euro area. Almost all EU economies are expected to continue growing in 2023, then experience a pickup in activity in 2024. A few words, as usual, on the main EU economies. In Germany, the economy is progressively recovering after the energy price shock of last year. A rebound in industrial production and construction took place in the first quarter, but domestic demand remained sluggish. GDP is forecast to grow by a subdued 0.2% in 2023, led by net exports, before accelerating to 1.4% growth next year, led by investment and especially consumption. In France, growth is projected at 0.7%. Investment is set to slow down on the back of tighter financial conditions, while consumption is expected to remain sluggish this year. The economy will gain momentum in 2024, reaching 1.4% growth thanks mainly to higher consumption. In Italy, real GDP growth is forecast at 1.2% in 2023. Economic activity remains supported by investments, while net exports contribute positively to growth. GDP is expected to expand at a similar rate next year by 1.1% thanks to a recovery in consumption, while the contribution from investments and external demand slows down. In Spain, economic activity, which is still recovering from the pandemic slump, is expected to decelerate this year, as in all the other EU countries, but the rate of expansion of 1.9% in 2023 remains well above the EU average, thanks to the implementation of the RRF and a very strong labour market. The country's economy is set to expand further by 2% in 2024, driven by consumption and investment. In Poland, growth is expected to slow markedly this year, and elevated inflation, tightened financing conditions, and low consumer and business confidence take their toll on domestic demand. Economic activity should recover next year as inflationary pressure gradually subsides and financing conditions improve. Overall, real GDP growth is forecast to slow to 0.7% this year, before rebounding to 2.7% in 2024. Lastly, I mentioned earlier that this forecast for the first time covers also the new candidate countries. Let me mention Ukraine. For Ukraine, this section gives an idea of the immense shock caused to the economy by the war, but also of the tremendous resilience it has shown. After a drop of around 29% last year, the economy is projected to grow by 0.6% this year and 4% in 2024. Of course, these projections are subject to all the caveats you would expect in the current wartime situation. That this is the forecast in the situation as it is now. Inflation. Inflation continues to fall thanks to rapidly declining energy prices. The euro area headline inflation fell to an average of 8% in the first quarter of 23, down from 10% in the final quarter of last year. However, as you know, core inflation remains persistently high, rising in March to an all-time high of 7.5% in the euro area. According to the recent flash estimates for April, it declined to 7.3%, corroborating our projection that the peak in core inflation is behind us. Looking ahead, headline inflation is set to continue slowing. Core inflation is expected to slow more gradually as pressures from past cost shocks wane and financing conditions tighten. However, it should remain elevated throughout the forecast horizon, reflecting the strong wage outlook. So inflation in the euro area is still projected to decline from the 8.4, which was 2022, to 5.8 in 23 and 2.8 in 24. On inflation, the intra-EU differences are expected to remain very high this year, but to narrow next year. As core goods and services take over as the main inflation drivers, the wide range of inflation projections predominantly reflects differences in the outlook for core inflation. This can be attributed to different domestic conditions and particular wage growth. Inflation in Central and Eastern Europe is still markedly higher compared to the rest of the Union. For the most part, this reflects domestic drivers, including higher wage growth and, of course, exchange rate movements. Public finance. The strong nominal GDP growth and the reduced cost of the pandemic-related emergency measures supported the further reduction of the EU government deficit in 2022 to 3.4% of GDP, 3.6% in the euro area, despite sizable energy support measures still in place. In 23, and especially in 24, the gradual phasing out of energy support measures is expected to drive further deficit reduction on aggregate in the EU to 3.1 and 2.4 of GDP. 3.2 and 2.4 in the euro area. The debt to GDP ratio fell to 85% of GDP in 22 from the record high of 92% in 2020 after the pandemic, during the pandemic. This debt to GDP ratio also is projected to decline further to below 83% of GDP in 24, but to remain above the pre-COVID level of around 79%. This was the 2019 figure. In the euro area, debt to GDP is higher. That peaked at 99% of GDP in 2020, and it is projected to dip just below 90% by 24. While inflation can support the improvement in public finances in the short term, this effect is bound to dissipate over time as debt repayment costs increase and public expenditure are progressively adjusted to the higher price level. On the budgetary outlook, several member states are still projected in 23 to see a deterioration in their general government balance. While falling energy prices are helping to contain the cost of existing support measures, many governments have introduced new measures or are extending existing energy support measures. In 2024, the deficit reduction is broad-based across countries, driven by the almost complete phasing out of energy support measures currently projected for next year. So the number of countries with a deficit exceeding 3% of GDP is set to increase from 11 in 2022 to 14 this year, before falling again to 10 member states in 2024, based, of course, on unchanged policies. The balance of risks. The balance of risks, while the baseline projections for the EU economy has slightly improved since our winter forecast, downside risks have increased to a better outlook, but a balance of risk tilting to the downside. Why? Because core price pressures could turn out more persistent if wages accelerate more than currently projected and without adjustment in profit margins. This is one risk. Higher than expected core inflation, another risk, would lead to a stronger reaction of monetary policy with broad macroeconomic ramification for investment and consumption. Risks related to the EU external environment remain elevated. New uncertainties following the banking sector turbulence or related to wider geopolitical tensions, rising interest rates on vulnerable emerging markets. And of course, Russia's war of aggression against Ukraine continues to cast a long shadow of uncertainty over the economy. This is not only a human and geopolitical problem, it is also and broadly an economic big risk. On the positive side of the balance, more benign developments in energy prices or a faster transmission of wholesale energy prices declines to consumers would lead to a faster decline in headline inflation, with positive spillover on domestic demands. In conclusion, let me highlight a few takeaways from today's spring forecast. First, I think we should be proud of the fact that the European economy is showing such remarkable resilience. This is no small achievement, given the nature and the magnitude of the shocks experienced. Management of the energy crisis, coordination of fiscal policies, and impact of the RRF. All of these have contributed to a much better than expected scenario. If we look back to what we were expecting last autumn, the scenario is much better. Second, this is no reason for complacency, as we always say. Inflation remains high. This means we must ensure that fiscal policy is consistent with our policy priorities. And in the same vein, it is important to maintain the momentum for growth in the implementation of the recovery and resilience plans. Third takeaway, the forecasts illustrate remarkable country differences concerning public finance, but also growth and inflation. It is important to monitor this divergence to avoid that they become entrenched. And finally, our forecast vindicates the more country-specific approach to fiscal surveillance that is at the centre of our proposed reforms to the EU fiscal rules. And this is a further incentive to reach agreement on this reform by the end of the year. Thank you, and I'm looking forward for your questions.
Indeed. Please raise your hand, introduce yourself and the media you're working for, and I will give you the floor. David, you have the floor.
Thank you. David Carretta, Radio Radicale Italian Radio. I will ask my question in Italian, if I may. Commissario, volevo chiederle due cose. La prima, qual è il contributo della Recovery and Resilience Facility
What is the contribution of the Recovery and
crescita
Resilience Facility
del PIL
to
dell'Italia? Abbiamo
growth
visto
of Italian
l'assorbimento
GDP?
teorico dei fondi,
We
quindi
see
quanto è importante
theoretical absorption. So what I'm asking
gli
is
investimenti,
how
le riforme
important is
vengano
it?
portate
How
avanti
important is this
per
investment
le stime di
moving
crescita
forward
che sono
for
indicate
the
nelle
growth
previsioni.
estimates that you've indicated in
La
those
seconda
forecasts?
domanda
That's one thing. The
è una
second
sorta di
question
ritorno
is a
alla
sort of
normalità per la crescita italiana,
return
soprattutto nel
to
2024,
normalcy
ma
for Italian growth,
non mi pare
for
per il
2024.
verso giusto, nel senso che torna a essere l'ultimo paese in
But
termini di
it's
crescita di PIL il
still
prossimo anno.
the
Quali
slowest
sono le
country
ragioni
in terms of growth.
questa
reasons?
divergenza rispetto
Why
ad altri paesi
The
della
difference
zona euro?
between Italy and other countries of the Eurozone, would you say?
Ma risponderei in italiano.
My
Senz'altro
answer,
il contributo
the contribution,
in Italia lo chiamiamo PNRR,
of what we call the PNRR in Italian,
come avete
is
visto,
fundamental.
abbiamo indicato
We've
un contributo,
indicated
diciamo, assumendo che i tempi,
the contribution,
gli obiettivi, quindi delle erogazioni vengano rispettati, pari
certain
al
parameters are respected,
2,5%
and we think it's
nei 3 anni,
2.5% over 3 years,
che insomma è molto consistente.
which is considerable.
Aggiungerei che
I'd add to that
in una fase in cui per combattere
at a
l'inflazione
time when to fight
i margini di politiche
inflation,
espansive sono ridotti,
the margins for
avere a
expansive
disposizione
policies
per
are limited,
spese soprattutto
then
per
having money
investimenti,
available
soprattutto per
for
investimenti
investment
orientati al futuro, uno
and
strumento
for
come il
future-looking
PNRR
investment,
è un'occasione
an
straordinaria.
instrument like the RRF is extraordinary.
L'Italia, come gli altri
An
paesi,
extraordinary contribution,
deve fare ogni
and
sforzo
Italy
per
must make
raggiungere.
every possible effort to
Quanto
use
alle
it
prospettive
properly.
di crescita,
Now, as to the growth
possiamo vedere
forecasts,
il lato positivo o
there's
il
a
lato
positive side
negativo.
or a negative side. You can look at
Lei
it either
Carretta si è
way.
concentrato su quello negativo,
David
io
Carretta,
segnalo
you
anche
focused
quello
on the
positivo,
negative side,
nel
but
senso
I
che
pushed
credo
the
che per
positive
l'Italia sia
side.
interessante
I think it's interesting to
che
look at both,
nell'anno in corso
and I think it's interesting
noi
that
proiettiamo per
we're
l'Italia una
forecasting
crescita
for
più
Italy
alta tra le tre
strong
maggiori
growth,
economie europee.
the biggest of the three major
Credo che
European
questo non
economies,
avvenisse da
in a sense.
molto tempo.
And that's not happened for quite a while, as you
L'Italia ha
know.
avuto una crescita negli
Italy
ultimi 2 o
has
3
seen
anni
growth over the last 2 or 3
pari al
years,
12%,
which was
molto significativa,
12%. That's quite significant,
che certamente
and certainly
era successiva a una
it
crisi
has followed on
meno 9 durante
from
la pandemia.
a serious crisis
Ma la crescita è stata
during
molto
the
significativa.
pandemic. The growth has
Il
been
rallentamento
significant.
che noi prevediamo per
The
l'anno
slowing
prossimo,
that
che è
we're
diverso
seeing
dalla
next
proiezione del
year,
governo,
which is different
la
from the
diversità
government's
dipende
forecasts.
fondamentalmente dal
Fundamentally,
fatto che
this is
alcuni aspetti di
because
politica
of
espansiva
certain
che il
expansionist
governo considera
policies which the
non
government
sono
is
ancora
considering
definiti nei loro
are not
contorni,
yet
quindi noi non
fully
possiamo tenerne
defined.
conto.
So we
E in
can't
secondo
take
luogo
them
dal fatto
into
che
account.
noi prevediamo
But also there is the
un
fact
livello di
that we
investimenti meno
expect
favorevole
a lower
rispetto alle
level of
previsioni
investment
italiane. Ma
when compared
complessivamente
to
penso
Italian
che
forecasts.
non
But
possiamo
on the whole,
dare una connotazione negativa a queste previsioni
I
che
don't see
sono
much negative
tutto
in
sommato
those
molto
forecasts,
incoraggianti per
which are
quest'anno
and remain
vedremo
encouraging
per
for
l'anno
this
prossimo.
year, and we will see for next year.
I'll take your question, Janos, and then I'll move to the Interactio platform.
Janoshan Bahaman from Euractiv. Now, this morning, President von der Leyen just had a speech in Parliament saying that the conventional economic model we have now is not applicable anymore. We cannot go on like this. Now, if the Commission were to take that seriously, I would expect at an economic growth forecast session like this one that we talk about resource consumption, that we talk about emissions and other stuff. Now, this still feels like a very conventional economic growth forecast session. So, why is that, and are there any plans to change that?
Well, this is a very good question. It was interesting, 2 or 3 days ago we had in Niigata, Japan, an interesting conversation with Joe Stiglitz. You may imagine the subject of the conversation, which was the effort that Stiglitz is doing on the label Beyond GDP effort. I think here we are working. We are considering in our recommendations, in our policies, with a stronger role, not only the environmental dimension, but the social dimension. We should gradually include more and more the sustainable and development goals. And I think you will perceive this more and more in our what we call semester packages, the country-specific recommendations to member states. So we are fully aware of the need of improving this. We encourage green budgeting to member states. But then you are right, at the end of the day, at the end of the story, when we look to the IMF, the OECD, European Union forecasting and outlook, most of the attention is on the internationally recognized indicators that we presented this morning. So this is a work in progress. I think we have to improve it. This doesn't mean that GDP will disappear, but this means that in our fiscal policies and recommendations we should more and more, and we will do, and we are doing it, include the different dimension of economic well-being.
Now I'll give the floor to Maria Psara. Maria is joining us via the Interactio platform.
Good morning. Thank you for the floor. Maria Psara with the FC newspaper Greece. I have 1.5 questions on Greece. The outlook for Greece is generally positive, Commissioner, but the economic activity will slow down in 2023 and further moderate in 2024. Is that a concern for the Greek economy? And the half question, is investment grade likely this year? Thank you.
Well, we honestly, everything can always be better for everyone. But in the case of Greece, it is clear that we revised substantially upwards our forecast. I've seen in important newspapers in these days stressing the good performance of the Greek economy. So overall, I think that the results are very, very positive. We have a 2.4 projection for growth this year, which is the double of the euro area average. And of course, the we will see the evolution next year, but it's difficult for me to underscore negative elements, because we have a lot of positive elements. But of course, no complacency, closely monitor, blah, blah, blah.
Now I'll pass the floor to Anna Matos, who's joining us online. Anna, you have the floor.
Hi, can you hear me?
Yes, we can hear you.
You cannot see me, right?
No.
No.
Okay, and I'll do my question anyway. I thank you so much for the floor. Commissioner, I have a couple of questions on Portugal. I wonder how concerned is the European Commission about the housing market in Portugal, in its influence on the financial stability, and how does the European Commission monitor the performance of the Recovery and Resilience Plan, given that some delays in the implementation have been known? And I wonder also, if I may, if Portugal already submitted rescheduling of its plan of RRF. Thank you so much.
Well, thank you. Overall, we see a positive forecast for Portugal, as you have seen, and growth is again 2.4, which is again double than the EU average for this year. So we can't describe this as negative. Interesting to note also that the budget balance of GDP, despite a certain number of significant energy-related measures that had a substantial impact on the budget, but overall the budgetary balance is well better than other member states. I reminded before that we will have this year more or less 14 member states in our forecast over the famous 3%, and this is not the case for Portugal. So we are cooperating with the Portuguese authority on RRF. I don't see we have technical delays in the implementation with many countries, but I don't see specific problems, both for debt sustainability and for the implementation of the RRF.
Just to answer your last question, Portugal has not submitted a revised plan just yet. Then I'll pass the floor to here.
Luis Tobar, Mediaset, España. I would like to know if you have taken into account the drought and the dry periods and the lack of rainfalls in countries like Spain, Italy or France, and if you consider this drought a threat in terms of inflation in certain sectors in a short or medium periods of time. Thank you.
Well, of course, the impact of drought was very important in several countries, and Spain is among these countries. But I think it's interesting also to note that the energy mix of the Spanish situation was overall a positive one. We can discuss on the extension of what is called the Iberian model, but for sure the contribution for Spain was overall positive. As you may have seen, our projection for growth are quite encouraging for Spain, despite the fact that we have slightly different forecasts in relation to the budget balance from the Spanish authorities. We have good projections for growth.
Susanna, you have the floor.
Thank you. Susana Fresh, SIC Portugal. You were mentioning for Portugal it is a good forecast. Nevertheless, we also see in the document, and you are pointing to the declining in purchasing power of households, also higher interest rates, which is a big problem for the families in Portugal nowadays. Also, you were mentioning earlier that financing conditions are set to tighten further. So isn't this a contradiction? Aren't you missing the social dimension that you were mentioning earlier? And also, in the document, you are pointing to these wage adjustments that are expected to keep pressure on prices and inflation. What exactly are you recommending? Thank you.
Well, indeed, there is a contradiction, but the contradiction is in the reality. So we have, for sure, from one side, loss of purchasing power, the results of increase of wages is projected to be stronger next year, but this year for sure is not in itself keeping the purchasing power in relation to inflation. So, of course, there is this social aspect that you have to take into account, but at the same time you have to try to avoid a price-wage spiral. So how to deal with this contradiction? Well, first, I think we take note of the fact that in several countries you have also measures taken to support households in relation to the increasing living costs. And these measures were taken also in Portugal, for example, income support for rents, VAT exemption for selected goods, and increase in the remuneration and pensions for civil servants. So we take note of this kind of measures. They have to, we have also to consider the fact that especially in some sector where pent-up demand was more strong, we have margins and buffers in substantial profits to cushion the impact of wage increase without bringing this wage increase to influence too much the rise of inflation. So there is a margin, and this margin is, of course, probably declining in the next years, but nowadays it is there, and it is particularly there in some sectors where the recovery from pent-up demand is more clear. And this is very clear both in our analysis and in the ECB analysis that you may have seen.
Yes, you have the floor.
Yes, David Thomas from MNI. I'm just wondering how you're going to handle the fiscal recommendations in the upcoming country-specific recommendations. I mean, obviously you, Commission, proposed a 0.5% safeguard. Germany is pushing for 1.0. So obviously it's a transitional period, so I'm just wondering how you're going to finesse that. And then on Eurozone core inflation, you have an average forecast of 6.1% this year. The highest we've actually had so far is 5.7 in March. So I'm just wondering where you expect the peak of Eurozone core inflation to be this year, if you can say, and maybe where it might end the year at. Thank you.
Well, on the evolution of core inflation, of course, we had some surprises in the course of these recent months. We reached a peak in March. In our view, this was a peak. Apparently, according to the flash estimates, it was indeed a peak because the April flash estimates show a small decrease, but they are still at 7.3% in April, and they were at 7.5%, and this is the reason why we consider the path of reduction of core inflation very, very gradual, very slow. The country-specific recommendation, of course, will be a fine-tuning exercise. I will not anticipate today something that we are still discussing in these very days. The only thing that I can say is that we have to work on this country-specific recommendation, taking into account the situation we are in, taking into account the fact that most of them, for several countries, are already in the national recovery and resilience plans, and we don't want to duplicate too much our efforts, and that we have an ongoing discussion on fiscal rules. But the final line of this is that we can't anticipate the conclusion of this revision of fiscal rules in our country-specific recommendation.
Any more questions today? I don't see any, so I would like to thank Commissioner Gentiloni for coming down to the press room today and all participants for your questions. So this concludes today's conference on the Commission's Spring 2023 Economic Forecast. Thank you and have a very nice day, everyone.